All right, good evening. Thanks for joining us, guys. Second to last seminar of the series. Lots of you have come every week, so it's been nice to see all of you. Again, for those who don't know me, my name's Angie Schick. I'm the program manager for the competition. I don't have too much to say here because we've got a big panel of speakers. So you're going to get a nice survey of different financing options and everything from government to crowdfunding to angels to VCs and when and where and how you should be doing things. So in 2 hours, it's going to be a great introduction, but then, there'll be more to learn after that. But hopefully this gives you a good overview. So we're going to start the first hour of the night with Neil Gibson from the NRC Concierge. He'll be covering off a lot of government options and as well talking about the financing options what the NRC Concierge service does. And it's a really good service. You haven't used them yet. Definitely you'll want to engage with them. Next is going to be Daryl Hatton from Fundraiser. He'll be talking crowdfunding of all types. Then we're going to take a break. And then after the break, Jenny Yang and Mike Walkinshaw, they're sitting at the back right there. They'll be talking about capital plan, angel investing, VCs, and all sorts of things around there. So should be a good night. I'm going to quickly thank our sponsors, and I'm going to hand it off to Neil to get us going. So our title sponsor is the BC Innovation Council. Our gold sponsors are Ernst & Young, Van City, Thaskin Martineau, and the Vancouver Economic Commission. Silver sponsors are BC TIA, CDRD, SFU BD School, UBC Cider School, and Progressa. And our bronze sponsors are Acetech, Webnames.ca, VEF, Rocket Builders, Skyrockets, Spacecraft, Front Funder, and Pusher Video. All right, over to you, Neil. Thank you.
Thanks very much.
Oh, and don't forget, questions into the microphone.
Can you hear me? Good. So my name's Neil Gibson. I'm Innovation Advisor at the NRC Concierge. Just out of matter of interest, who's heard of the Concierge? Hands up. Wow. Still people who haven't got haven't learned about it yet. So basically, I'm going to talk a bit about what the concierge is, how it works, and then I'm going to give some examples of some of the current programs, the sort of things that we refer companies to. So the concierge is around about 2 years old now. It was born out of the Jenkins report. It's a free service offered by the National Research Council. And we fall under the IRAP umbrella, which is the Industrial Research Assistance Program. And the idea was that there was no one single place which small and medium-sized companies could come to learn about all of the different government programs and services which are available for them, particularly in the innovation sector. So the concierge was born, and the service is delivered by innovation advisors such as myself. There are 15 of us nationwide, 3 of us in BC, and we service BC and Yukon. And we're dotted all around different partners in Vancouver. So the mandate for concierge has been narrowed recently. And basically what we're looking for are those small and medium-sized companies which are R&D based, so doing something innovative. And they're developing a product, a service, a technology, or even a platform. And they obviously have that impetus and that drive to grow their company through revenue and job creation. So as you probably know, job creation is a very important focus of a lot of these programs. How it works is you would arrange a meeting with you contact concierge, you'd arrange a meeting, and we'd have a consultation either in person or over the phone for around 30 to 40 minutes, just to get a top-line understanding about your company, what stage you're at, what the sector you're working in, and the type of innovation you're working in. And then from that, we can work and give you some referrals and some leads on the sorts of programs you could be making use of. We partner with all the different government programs and services, both on the federal, provincial, and municipal level. We try to find all those sorts of things which can be useful for companies in all sorts of different shapes and sizes. So when we talk about funding, it may not be just cash or money. It could be R&D assistance, it could be hiring assistance, it could be a loan, and there's other options as well. So I'm just going to talk about quickly, top line, about some of these things that I don't have time to go through them all, of course, but I'm going to just talk about some of the top line ones. So R&D assistance. The first one up is, of course, the Industrial Research Assistance Program, which is run by the NRC. And the idea is similar to the concierge mandate, is to support SMEs which are having those technology-driven activities. And they're also looking for those companies which are looking to incorporate that technology into their competitive products or services, and of course to grow their services and be commercialized, and to commercialize not just in Canada, but hopefully on the global marketplace as well. So to be eligible for IRAP, it's a pretty simple thing. You have to be SME incorporated in Canada for profit. You have to have less than 500 employees. You have to be willing to have a trusting relationship with IRAP, and because it's administered through what's known as Industrial Technology Advisors, or ITAs. And again, as I mentioned, you have to have that objective to grow, generate profits, take on new employees, and to basically grow it in Canada and globally. So when you've fulfilled all those criteria, and these will be on the website, you still may be eligible for support, because I can imagine it's a very competitive process. IRAP's administered through Industrial Technology Advisors. They're around about 30 to 40, servicing in BC. They're often entrepreneurs themselves, or formerly entrepreneurs themselves. They have experts in their sector. And they can offer the companies some expert advice. They can help with making networks, encouraging partnerships. There are a number of current offerings under IRAP. There's the Youth Employment Program. There's the new Youth Green Program, which is a similar sort of youth employment program. There's also a couple of international offerings to help collaboration internationally. The Canadian International Innovation Program, and Eureka, which is focused more in European collaborations. I put financial contributions at the bottom there because it's a competitive system, but certainly the ITAs can offer some financial contributions for small projects. Next up is SR&ED. So hands up who hasn't heard of SR&ED. It's basically the biggest innovation incentive in Canada. I think the latest figures are $3.6 billion, which was handed out by the CRA, and I think that dates back to 2011. And there's been a few tweaks, but it's still a fantastic offering for companies to recuperate a lot of the expenditures that they may have for their R&D activities. So it's a tax credit. You can get as much as 64% of your eligible R&D expenditures back at the end of your fiscal year. And this will be for employees and salaries for a Canadian-controlled private corporation. Then you have to create an R&D project, and for that project you have to have three criteria. You have to fulfill three criteria to be under the definition of R&D in the CRA's eyes. So you have to have a technological challenge, you have to have a technological uncertainty, and you have to have a systematic investigation as well. So, for example, it's no point you can't just buy some technology to advance your technology. You have to have a challenge in some respects to get that, and we don't mean a financial challenge. It's very important to keep documentation because at the end of the fiscal year, when you put in your tax claim with your T661, you have to justify all of the salaries and the materials consumed, for example, that you've taken in the course of your R&D. The CRA offers free pre-project approval service, so it's worth talking to them from the get-go to find out about whether you're eligible for SR&ED. In BC, it's also worth mentioning the interactive digital media tax credit. So this is another type of tax credit which is similar to SR&ED, but it's focused around those companies which are creating educational or sort of edutainment type of software. The key thing here is that you have to be registered in BC, of course, but also you have to have over 100k in eligible salaries. But you can realise at the provincial level 17.5% tax credit for those sorts of activities. And this is compared with 10% on the provincial level for SR&ED. Another angle, another way of getting some R&D done is to tap into the facilities of a university or another sort of institute. So NSERC, which is the Natural Science and Engineering Research Council, offer the NSERC Engage program, and this is designed to encourage collaborations with universities. So if you know of a university who have some equipment or some facilities that you want to use, then you can approach NSERC and see if they'll sponsor your project. The idea here is that the money goes to the university, and so the university will do the work on your behalf as a company. But it's important to note that the outcome, or anything that comes out of that, any IP which comes out of that, it belongs to the company and doesn't go to the university. You have to have at least 2 full-time equivalents in the company or have been in business for 2 years. Finally, on the R&D assistance, there's MyTax. So MyTax is another one I'd like to mention, where you can actually hire some well-trained, educated graduates at MSc and PhD level. Under the MyTax Accelerate, you can get 4-month chunks of internship with these graduates, and MyTax will match 50% up to a value of 7.5k for these sorts of placement. I believe you can add chunks up to 12 months. In fact, we have a representative of MyTax in the audience, Armin here, so I'm sure he could help with any questions about MyTax that you have. And then later on, if you want to take on a more longer term, then you can use the MyTax Elevate. Loans, I'm not going to talk too much about this, but Concierge can put you in touch with lots of different sorts of institutions which offer small business loans. I'm going to talk a bit about hiring incentives because these are really popular, and it's really a no-brainer. If you're looking to take someone on, or you want to audition someone, then this is the great time to start using some of those hiring incentives. I'm just going to run down some of the currently open hiring incentives as well. So BCIC, they have their Tech Co-op grant, which is 2.7k subsidy for taking on a co-op student. This is for companies who are taking on their first co-op student or for students in their first co-op placement. And
So they give it to any co-op student. So it can be the first year or second year, but if it's your first hire semester, so you can hire senior students as many as you want.
yeah.
25% is aptitude, so you don't have to max 25%.
Okay. Because there's the other one. There's another offering by BCIC as well. So, but I'll check on that. But thanks. So that's the co-op grant. Now we've got the NSERC Experience Awards, which was formerly known as the Industrial Undergraduate Student Research Awards, which is a bit of a mouthful. It's again run by NSERC. It's a 4.5k. Subsidy to hire an undergraduate for 16 weeks.
Hold on, one question here.
Is the limit for this one and the previous one are per year, or is that a lifetime limit?
I believe it's on a lifetime thing. I don't know if anyone can help with that, but I think that's the response for that. Typically we can get you in touch with someone from NSERC who can give you some top line, get some more details there. But I think they do take into account how many people you've taken on in the lifetime of your company. Freshly open is the YMCA Digital Skills Youth Internship Program, and this is a great program if you're looking to take on a student to do some in terms of digital skills. Now they're offering $16 an hour for 16 weeks, and that plus 4% holiday and any other mandatory employment-related costs. So this equates to around about 10K in subsidy for hiring a student. You have to have a minimum of 5 employees, and you have to be in business for 2 years. But this opened up this week. Similarly, ICTC is a 14K subsidy for taking on a recent graduate in ICT jobs, and you'll notice these are getting bigger now. So this one's just opened. One of the mandates is that you have to have the intention to take on the person in a permanent position. In the environmental sector, the Eco-Canada offer 15K for the Environmental Youth Corps internship program. Again, it's a 50% match, looking to take on someone in the environmental sector. And finally, BioTalent opened up this week as well, the career focus. So they're offering a 20K wage subsidy, 50% match, for hiring a graduate in the biotech sector with quite a wide range of different jobs, from manufacturing right through to biosafety, QA, QC. So it's a really great program. I'm just going to touch on a couple of the other examples.
One question.
Yeah.
Neil, you mentioned at least 2 programs that you said just started recently. Is there some sort of impetus to that? Why they were released just now?
It's a matter of the money being filtered through and being ready to be released. There was some hold on funding at the end of last year with the change of government, and we're now just seeing some of those programs just opening up again. So other types of assistance, I'm just going to touch on these. There's the Building Canada Innovation Program. This is for companies which are past a lot of their SR&ED phase. So they're in what we know as a higher technological readiness level, between 7 and 9. So you're close to commercialization. And a lot of people don't realize that if you have a thing, you have a service or a piece of technology, it's worth applying for the Building Canada program before you're commercialized, so that to tender out your idea to the government. It's basically a procurement program to make the government your first customer. So you can realize up to $500,000 in orders, and there's also the opportunity to have comeback orders as well from the government. So it's really worth looking into. Again, for those companies which have passed the SR&ED phase typically. So also, one of the questions I often get is there any money for going to trade shows, going internationally and looking into international markets? The CAN Export is offered by Global Affairs, and it's, again, a fairly new program. And the idea here is to encourage you to look at and break into different marketplaces in different countries. So if you haven't broken into a particular country, then there's the opportunities for them to cover 50% of your expenses to travel to trade shows and do market research and that sort of thing. One of the caveats is that you have to be quite well established in Canada to begin with. So you have to have at least 200K in revenues in Canada before you can apply for the CAN Export. But still, it's something which is fairly new, and it's very different to what we've seen previously. So, yeah.
Sorry, is that a 200,000 revenue from Canadian companies, or is that just revenue coming into a Canadian business?
As a business, you should be making 200K revenue.
Okay. Yeah. But that doesn't have to be generated from companies based in
It doesn't have to be.
Oh no, you could be in another market, but this is for breaking into a new country. So if you're established in a different country, you can't in that country, then you can't use it for that. For that, yeah.
Yeah. Does the trade show have to be international, or does it count if it's in Canadian soil and market research has been done in Canadian soil?
I'm not sure about that. I mean, if it's related to the idea is you're looking to break into another market, another country. But if the trade show's in Canada, it's related to international relations, then that may be qualified. You'd have to check. Again, I can refer you to someone in global affairs if you want to talk to them about that. So that's it. So that's just a quick overview of some of the things that some of the partners we work with in Concierge. I'll just put a shameless plug there for my Twitter account. But we try to keep people up to date with all of these sorts of things over Twitter. It's a great way of instantly putting it out there. So any more questions?
Do you really start work at 4:30 in the morning?
No, that's the number. That's not. And this is
All right, any other questions? All right, thank you very much, Neil.
Thanks.
So Neil, I don't think can stay till the very end, but he can stick around for the next 30 minutes or so. If anyone wants to ask him any questions, feel free to flag him down. I'm just going to get Daryl's presentation up and running here for you now. It's on the tables. Great, thank you. All right.
Are we live?
Yes.
1, 2, 3. Good.
So Daryl, as I mentioned, is CEO of Fundraiser. He's also past top 10 and Social Venture Prize winner of the competition. So he's here to talk all things
You're stealing my
crowdfunding.
thunder.
All right, I'll stop talking.
I'm a product of this process. Okay, so we ended up going through the competition a couple of times and finally getting somewhere in the second try, which means we're now disqualified. So we can't go in it again. But it's been I also come back and mentor and judge, so I love this program. I'm the founder and CEO of Connection Point, which is a company based here in Vancouver. We're better known by our brands for crowdfunding, Fundraiser, CocoPay, and Sponsify. Fundraiser is a general crowdfunding platform, helps anyone raise money for any type of cause. CocoPay is a crowdfunding solution that lets people crowdfinance a purchase from a company. And Sponsify is a sponsored crowdfunding system that helps a company use crowdfunding as a marketing tool. So we've helped, we're an international company. We're based just down the road here in Gastown. We've got customers in 20 different countries. We've helped raise over $81 million for over 60,000 campaigns worldwide. Anything from campaigns to raise $500 for someone because they have a small need to we've done $1 million campaigns for scientific research and not-for-profits and that kind of thing. So it's been a pretty fun ride so far. I'm going to talk to you about innovations in crowdfunding and specifically, hopefully, help you understand the different aspects of what crowdfunding is all about and how it might apply to what you're doing to help you fund your business as you move forward. The trouble with crowdfunding is a little bit like the proverbial blind man and the elephant. What it is depends on what part you've touched. If you touch the trunk, it looks like a snake. You touch the ear, it looks like a fan. And if you touch the tusk, it looks like a spear. But they're all part of an elephant. And the reason it's confusing is that it's so broad in how it can be applied. People can use crowdfunding for helping your sport team raise money because they need uniforms, they need to travel to a competition. Or you can use it because you've got a traditional not-for-profit that's trying to fund one of their projects or causes. Or you could use it because you're an Obama lookalike and you want to try and go and get yourself elected in an election. Or you can use it because you're someone who's had a personal health care crisis. You don't have enough money to get through that, and your friends and family will help pay for your bills and help you get through the cost of treatment, especially important to our American friends, and while you're laid off. And then the more important one for all of us here is that you can also use crowdfunding to help fund your enterprise, either the startup of your business or the funding of a project or helping you raise capital to grow or expand. So all of those are available. So the common thing about all of that is that my definition of crowdfunding is that it's people working together to use internet technology to solve a funding problem. I'm not talking about a platform. I'm not talking about a specific model where we're going to use equity or debt or donations or rewards or anything like that. It's just about people working together. That's the elephant. So the challenge is that, as I mentioned, there's a whole bunch of different models that we want to talk about that are all part of the same topic. So we've got things that are called rewards or donations, or where you could crowdfund to sell equity in your business, or where you might get a loan from people using crowdfunding technology. Or the latest development is where you end up with a marketing system based on that. That's what our Sponsify brand is all about. So what we're going to do is talk about a couple of these different models tonight and try and figure out how it might apply for you. First one let's talk about is securities. Securities is about selling any aspect of kind of a debt or equity instrument in your company. Could be royalties, where you're offering a return for an investor that's based on a financial guarantee that's put into a document that's called a security. So the reason we talk about it as securities is because there's a lot of different models. If we end up talking too much about equity, people will go, well, what if I wanted to give a royalty? Is that still a security? They're all securities. And the kind of the point, and Jenny will probably give me grief later, and she hopefully will, she'll correct any inaccuracies I bring up here. I hope she will anyway. The key thing about securities is that the Americans are all very excited right now because the Jobs Act is finally being implemented. And that's their program in the US to help companies raise money using crowdfunding. They've finally put it into gear this last week, and they're starting to get deals to go out. The interesting thing is crowdfunding's been legal in Canada for years. We like to think of ourselves as backwards, but in fact, crowdfunding's been illegal in BC using what's called an offering memorandum for a number of years. So let's not give ourselves grief sometimes as Canadians. We think we're always trailing Americans. We're not. And in fact, there's a lot of things that we've done recently in Canada that are, quite a bit ahead of American in terms of helping smaller companies crowdfund. But the key thing is that the US is one big, long system. They have what they call the Securities Exchange Commission that helps govern the entire country under one set of rules. Canada's not like that. We've got 10 provinces or 11 provinces all fighting for how they want to run it in their turf. And boy, it's a turf battle. So you end up with the BC Securities and Alberta Securities and Ontario Securities all having a slightly different approach to what it means to do securities crowdfunding. And for you, that's a complexity, because not only do you have to worry about where you operate as a business, but you have to worry about the rules that are dependent on where your investor comes from. If you're in BC and you want to get someone from Ontario to invest, you have to pay attention to special rules. These rules are all called exemptions. And a basic idea of an exemption is typical of a government. They say, you can't do anything. We're not going to let you do anything. But if you pay attention to certain rules that we'll give out, we'll give you an exemption to allow a certain activity. So an activity there is one that we're commonly familiar with. You can issue shares from your company to you. That's what's called a private issuer exemption. Or you can sell shares in your business to your friends, family, and close business associates. Lots of caveats on what's a friend, what's a business associate. Family's fairly understandable. But you can sell shares in your company that under the friends and family business exemption. If you're an angel investor, you can probably invest in a company using what's called an accredited investor exemption. Accredited investor is simply someone who's achieved a fair bit of financial success in their life, and they're deemed to have the knowledge and the ability to withstand the mistake if they make a bad decision on investing in your company. So they're allowed to invest in places where other regular consumer investors are not allowed to invest. There's other ones, and I mentioned the offering memorandum earlier. An offering memorandum is a document that's a little bit like a prospectus if you're going to do an IPO on a stock exchange, but it's a little bit simpler, a little bit. And you can then sell to a lot of different people under certain rules about how much and where they live and do they have resources to help you. The kind of key thing that we wanted to talk about tonight is there's two exemptions that have been passed recently that are important to you, I think, as a crowd. One's called the Startup Crowdfunding Exemption, and it's designed to help a small company raise a small amount of capital, small amount being kind of $500,000-ish max, using a crowdfunding platform. And that's pretty well understood and running in BC, Alberta, New Brunswick, Quebec, etc. The notable exception is Ontario. They don't like that one, so they don't want to do that one. So now if you want to try and use that exemption, you can't have any investors from Ontario to use that exemption. So they came up with their own. They called it the integrated crowdfunding exemption. And the idea of that is that it can go to a much larger amount of money, like a 1.5 million type raise, but the rules about what you have to do as a company are much more strict. You have reporting, you have ongoing requirement to report your financials pretty much forever. So there's some very interesting criteria about all this. Really complicated, right? Best person you can talk to is Alex Cormick. Alex is she's a national treasure. She is one of the world's foremost authorities on crowdfunding, and she lives right here. And her blog, which is what I've got up there, is a great source of information on human understandable interpretation of these arcane rules. So I really recommend that if you're doing something and you want to crowdfund it, check out Alex's blog for information. The other thing is that if you're going to do any of the exemptions, you need to, just make sure I'm not too far off time. Not too bad. You need to use a crowdfunding platform to help you use particularly the crowdfunding exemptions. There's a couple available in Canada that are actually operating and doing stuff. There's a lot of people who are saying they're about to do stuff, but there's not a lot that have actually done a lot of deals. There's one in Calgary called Seedups, and they've gone along a way, and they've actually done a few deals. And there's one here locally in Vancouver called FrontFunder, who happens to be a sponsor for this event. FrontFunder is important for a couple of reasons. One is that they have the ability to operate across multiple jurisdictions. They can do a deal that sells shares to somebody here in BC and in Ontario simultaneously. And it matters because where's the population in Canada of likely investors for you? Here, Alberta, and Ontario. The second thing is that they've actually done deals. And that may not seem like a big deal, but this is a big learning exercise for the securities regulators and for the platforms and for the investors and for the companies. So it's very important. That experience is crucial at this early stage. So you have to list your deal on a platform. And what does a deal look like? This is their pitch place. And essentially, you're doing what you would pitch to an angel investor. The documentation, the information that you communicate to that angel investor is encapsulated in a series of web pages on the site. The key thing that the platform is doing for you is not only helping you tell the story. That's just a basic kind of web function. But they're also helping to figure out that the investor that's coming there, what level they're allowed to see. If I'm a wealthy person, I can see any deal and I can invest in anything there because I'm an accredited investor. But if I'm only making $100,000 a year, I have limits on how much I'm allowed to invest, so I will not be shown some deals, or at least I'll be shown a deal and told I can't invest in it, which is kind of unfortunate. But it gives you an idea of the kind of deals. They have a wind turbine, a kids' play set up, and this is an investment fund, Peak Fund. How many here have a startup that has a woman co-founder? Anyone? Okay. You should pay attention to Peak Fund. They invest in startups that have female co-founders because it's about helping women get stronger in the industry. So that's an example of the kind of deals that are up there. What I want to show you here is that they've actually had some successful deals that have closed. And these are ones that are all local. So these are all BC companies, also in New Ventures BC. I think all of them have been. Kind of interesting, if I can get no, not the one I want. That one? No, whatever. Laser pointer. Thought it was that. Nope. Oh, no, I screwed it. Okay, slow down, right? Leave it alone. I won't do that again. Thing about Gusto, I don't know if you can't see it here, but that's $25,000 raise. Not a huge amount of money. They did the crowdfunding campaign for press exposure and the ability to be one of the first deals in Canada more than they did it to get the money. Compare that with Rent Moolah, who raised $2 million. Some of it was done on the platform, some of it was done by private investors, but they worked together to use the platform to help communicate the story to potential investors. So just give you an example of what's going on with that in town. All right. So we talked about equity and securities and how you might sell your shares in the company. There's another alternative model that's used by companies that traditionally have a consumer product, something that where you can sell to the general public. And that's what's called rewards crowdfunding. The basic idea of rewards crowdfunding is you're going to ask your customers to prepay for a product or service. You describe the product, you ask them to make a pledge to buy that product, and then you take the money and you go actually complete the work to do that. So this is the model that Fundraiser and Kickstarter and Indiegogo use for helping fund a lot of creative projects. And it's very important because it has some real advantages over the concept of equity, which I'll get to in a sec. So this is an example of a campaign that's like that, that's running using Fundraiser technology. This is a company out of Toronto called Thin Ice, and they have a vest that you put on that helps stimulate your body's metabolism by cooling it. And when it does that, based on research out of York University and a bunch of others, you burn extra calories and therefore can wear clothes and lose weight. I'm in. Okay, so they're using crowdfunding to help raise money for the original sale of their product. They've proven a bunch of it. They have a prototype for it now. They're using crowdfunding to sell the product to their market. So the way it works is they've got a campaign page that's set up, looks like a website, but it's actually running on a crowdfunding platform. And then when they get to a level like this, I don't know if you can notice up to the top right there, but that's what's called a perk or a reward, where the consumer can go and purchase that product by pledging it against your credit card. They take a charge against your credit card that if the campaign goes forward, they take money from it, and if it doesn't, they refund the money. So this is kind of the idea of what can happen with a rewards-based crowdfunding platform. Now, they've already built their product, and so they're just using crowdfunding technology to sell it. But what happens if you haven't built it yet? You've got your idea, you're thinking about what you want to do. The last thing you want to do is start taking some payments in for a product that you hopefully will be able to build, but may not complete. The last thing you want to do is get your bridge partway there and look over the abyss and realize you can't deliver what you've promised. You don't have enough money to complete it, and you may have encountered a technical obstacle that means that you can't complete it. So there's an aspect of rewards-based crowdfunding called the all or nothing model. Basic idea of all or nothing is you set a goal. I need X dollars in order to figure out this technical problem and build the original versions of the product that I can ship to my customers. And the idea of the rewards model is that, of the all or nothing model, if you don't get enough pledges to hit your goal, no one's charged anything. So it's fairly risk-free. You can put it out there and say, this is what we're trying to do. If you get enough customers to buy it, you go ahead, and if you don't, you stop. Everyone is not charged, so there's no cost. Now, the key benefit of that from an entrepreneur's point of view is, A, you get funding if you do it right, but B, it's very, very important you can test your product market fit. In other words, how well does your product match the needs of your customers, and how willing are they to pay for that? You're putting out an offer saying, I'm going to build one of these, and this is what it'll do for you. Do you want to buy it? And if the customers go, great, and they pile on with the orders, full speed ahead. But if they don't, you've got feedback from the market without having risked a whole bunch in order to determine whether or not your product is meeting their needs and your messaging is communicating to them what you need to tell them. So the product market fit is a key component of what rewards-based crowdfunding is all about. Now, the crowdfunding industry is going through an evolution. We've started with crowdfunding destinations. You go to Kickstarter, Indiegogo, Fundraiser, and you say, I'm going to list my project there. How many people have heard of, we listed our project on Kickstarter? That's a fairly important component of where it's been. But what happened is the smart technical people said, well, why are you using the platform? Why don't you just do this on your own website? And so they started to sell crowdfunding software and white label it to you. So a bunch of games have used this in order to fund themselves, where they built this into their own technology, and they ran a crowdfunding site to run it for themselves. The evolution of this is pretty clear. If you've ever done a website, you're not going to build a shopping cart technology. You're probably not going to go buy a payments processing technology. You're going to use shopping cart as a service or payments as a service in order to help charge your customers. Why wouldn't you use crowdfunding as a service? You plug crowdfunding into your own website as a service, gives you all the capabilities of a crowdfunding system without having to become a crowdfunding site. So this is what Thin Ice is doing, is because they now have control over what they're doing, they can test multiple versions of product market fit. Yes, sir?
Oh, hold on, sorry. Thanks.
The crowdfunding, it's what I see a lot when like my friends' kids are doing some sort of bike-a-thon or something like that. Is that crowdfunding as well when you have to pledge on the page and it starts to scroll who's donated? Is that?
It can be. That's a mechanism of a donations or a rewards-based crowdfunding site, is to show the backers that you already have.
Okay.
So it might be.
Okay.
Just depends on the context of where it was. So the key thing that's going on here is because they have control of the platform themselves and how they're doing it, they're looking at whether or not their product can reach different consumers and use it as a marketing tool to help them get more customers. So they've combined with Pavlok, which is a little device that reminds you about your exercise requirements and have you met your goals for the day. And they're co-selling these things together to their customer base using a technique called affiliate marketing. The reason this matters is, how many of you have heard of or know Dan Martell? Is anyone? If you haven't heard of him, look him up. Dan is an entrepreneur from New Brunswick, Moncton. He's had multiple exits of his companies. He's done a very, very good job of learning how to build a repeatable business for selling your company, building a good company and selling it. And he consults now in the US particularly, but also he's got a soft spot for Canadian entrepreneurs. His material, he does video lectures every week, and his material is phenomenal for you as an entrepreneur, especially the CEOs, to understand the pain that you're going through in doing this. Really recommend his stuff. One of the things that he talked about is using a technique called leverage OPN. OPN stands for other people's networks. And so in this case, their Thin Ice is leveraging the Pavlok's network of consumers they already have to reach out to a much larger market than they can grow organically. Now, this might seem advanced stuff, and if you're not consumer product stuff, sorry, you probably can just nap for a bit. But the basic thing is that that's a very, very powerful concept. So in that case, they were testing it with the Pavlok, and in this case, they're testing it with a Sensoria thing, which is a cooling sock for women runners. So they're just looking at different communities to try and figure it out. The reason these things have not even launched yet is like this was yesterday. So they're just starting this stuff. But I wanted to show you the latest techniques that are being used to do this. How are we doing for time? 20, good. Okay. Key thing that I want to do for the next minute or two is some myth busting. Mythbusters, one of my favorite shows. C4, when in doubt. Okay. Anyway, one of the largest myths, or the biggest myths about crowdfunding, is that you create this beautiful campaign page, you figure out what perks you're going to offer, you figure out what your equity story is going to be, you publish it out to the internet, and as soon as you do that, the heavens open up and the money rains down on you, and all you have to do is run around and scoop it up. You laugh. I have to disillusion an entrepreneur at least once a day about this. Okay? And the reason is that everyone wants to believe that the platform will bring you a crowd. It's all about they're going to come and hand you this huge market of potential consumers for your product, potential investors for your product. The platform's job is to build some of that, to bring you some of that. But if you imagine for a minute that a Kickstarter or Indiegogo will start 50 to 100 campaigns a day, and if you're a member who's contributed once to one Kickstarter campaign, you don't want to see 100 new campaigns a day and figure out whether or not you want to participate in them. That's not scalable, practical. You'll hit spam right away. So most of the campaigns have to do the job themselves of building their original crowd. And if you listen to what we all say, we say you got to get about 30% of your supporters in line before you really are ready to launch your campaign if you want to be sure you're going to be successful. So that, this is a bit of a fantasy. But when you do the work necessary, it does end up working like that because we are herd animals. We were on the savannah a long time ago. We learned to stick together and do things that other people were doing, mimic what other people were doing because it was a good survival technique. And it lasts to this day. People will buy because they see somebody else buying something. So it's kind of important to get that initial crowd because then your campaign has an opportunity to go more viral. Okay, second big fantasy. I'd love to tell you that this isn't the case, but I'm a CEO of a fundraising platform. It's not easy. Because what you're doing is you're hitting the focus of all the marketing activities that you have to do for your product or service right early on. You've got to figure out whether the message you're putting out and what you're doing with your product matches what your customers' needs are. That's that product market fit magic. So the key thing is that you should plan on taking a few months to work out what your story is, why it matters to your customer. I don't really care so much about your product. I care about why your customer cares about your product. And that's a good question as an entrepreneur. If you're talking about your product, you're probably talking about the wrong thing. Figure out who your customer is, talk about them. The solution gets a whole lot easier. So it's not easy. And the final thing that is really important to think about is it's not free money. Especially when you're thinking about securities or equity, you're giving out a component of your company. It seems like a good deal. You sign a couple of documents and somebody hands you $20,000. Like, that's awesome. But the thing that's involved in that or a rewards-based crowdfunding campaign is the commitment to deliver something later. And with the money that comes in for a rewards-based campaign, the reminder is you've got to not only deliver the product, but figure out all the bugs to make it useful to that customer by the time they get it. And that's a big challenge. It's why we live as entrepreneurs, but that's a big challenge. And if you're doing an equity campaign, it can be some of the most expensive money you'll ever buy by selling shares in your company. If I said to you, right now, I'd like you to take a loan and I want you to pay 1,000% interest, who will pay it? How about 10,000% interest? Your average angel investor is looking for kind of a 10 times return on their investment, or your VC, they're looking for 100 times return on your investment. That's a 10,000% interest rate. It may last over a couple of years, but remember that that's a big interest rate. So the more you can do to preserve your capital up front, not sell out shares in your company early because it feels easy. The angels and the VCs hate me right now. Because that's where it's the most expensive money you can buy, is to get that kind of funding. Now, at times, it's absolutely the thing you should do. But just beware, it's not free money. If I haven't given you a headache by now, after talking about all this, I probably haven't done a good job. But if you have questions afterwards, please let's make some time and talk about it. Yes, sir.
Oh, sec.
You did not mention a patent, because it doesn't matter what we start. If we don't have protection by patent, we're not going to last long. And there is no money for patents. We have to spend our own money. It costs between $5,000 and $15,000. There is no money. Nobody will give money for it.
Well, I think there's a debate about whether or not, I challenge a couple of questions on that. Whether or not you absolutely have to have a patent to be protected or useful in the market. Well, right. So there's a couple things. A lot of companies have started in a technological field that don't have patent protection before they become successful. So there's a preference for having a patent protection from an investor's point of view, without a doubt, but not necessarily the only requirement. So, and we can talk about that, that's a whole topic in itself. But crowdfunding can help you if you have an idea concept. You don't have to tell people how it works. In other words, you don't have to give away your trade secret, but you can tell them what it does and why a customer cares about that. And if you say, we could probably get a patent in this area, they may invest in you before you have the patent. Yes, sir.
Quick question. Have you seen any service-based businesses doing any reward-based crowdfunding? And
difficult model. It's a difficult model. So if you're trying to do a service-based business, essentially a subscription-type business, it really gets down to how well can you craft the message that you're doing to signing up, because with service-based model, you're typically charging per month. And so it's difficult to get the volume you need in order to justify the cost to acquire that customer. But it's possible. So I think you need to be very creative about how you pitch it, and particularly creative about turning that customer into an advocate to give you other customers. So one customer that you get is worth $20 a month or whatever that is. But if they're through their referrals can turn that into $100 of value for acquiring them, is that making any sense? It can be on crowdfunding model because you're relying on the social capabilities of a crowdfunding platform to help you find new customers in the same way. How are we doing? More questions? You've been very patient. I'm a little, oh, yes, sir.
Sorry, I think we'll take a break and you can talk to Daryl afterwards. Anyone? No, I think we're good.
All right.
Thank you very much, Daryl.
Thanks for your patience.
All right, 10 minutes, and then we get to hear from the angel and VC perspective next, I think. Thank you. We're going to talk more on capital planning. So first up, in the second half is Jenny Yang, and over to you.
Hi, hello. Everybody hear me? I have a soft voice, so I tend to, if anybody can't hear me in the back, just let me know and I'll shout louder. So thanks everyone. I know it's been a long day. I know I felt like it was a long day as soon as I got in here. So thanks for sitting through this. If I get boring and you start to fall asleep, I will not fault you. All right. So Angie asked me to come and speak. This clicker? No? Is that? Oh. Okay. Come and speak to you guys about venture funding, angel funding, and the like. And I think the reason she asked me because I've been on both sides of the table. I've been a VC myself for almost 10 years. I was at BDC Venture Capital for almost 10 years, and then I left that and started my own company called Metaphor Software. In 2010, we raised some money, and we exited that last summer. Splunk bought our company, so it's growing now in Vancouver, which is really nice. So I've seen it from both perspectives now, and after I was trying to raise money for many months, and it was really hard, a lot harder than I expected, I wanted to make a video, an I'm sorry video, to all the entrepreneurs that I had talked to before, because the fundraising is one of the toughest things you'll go through. It's a very humbling experience. So don't worry about it if you can't quite get there in one shot. I wasn't sure how much everybody knows here about fundraising and all that, so it's a fairly high-level presentation. So I figured there'll be Q&A, so if you want me to go deeper in any of the topics, I'm happy to do it. I had a few slides up here about term sheets and so on, but I believe Mike is going to talk about that later, so I'm just going to skip those ones. So if you have any questions about term sheets and things, you can ask him. He knows much more than I do. And something about pies. Apparently I'm not supposed to talk about pies, or I'm supposed to talk about pies, but the only thing I know about pies, I like my vanilla ice cream with pie, so that's all I'm going to say about pies, but I think Mike will talk a little bit more. But at a very high level, when you go out and look for funding for your company, there's a few different sources, and I generally break them down into equity and debt, right? As an entrepreneur, I prefer debt over equity. And why? Because then nobody else owns part of my company. So whenever I can, I favor debt over equity. But debt is very hard to get when you have no revenue, or you have tiny little bit of revenue and you have nothing to lend against. The lenders won't lend you money. Right? And so you kind of fall back into equity. That's why most people end up in equity. But if you had a preference, I would always choose debt, because I don't want to give up any part of my company unless I absolutely have to. And I have a few examples of the type of financing, both on the debt and equity side. There's some new ones that have popped up, like crowdfunding. That would probably go up to that first, along with the angel investors. There's other now debt instruments. Mike's going to talk a little bit about his fund. It's also a debt instrument for a slightly later stage company. But generally, the sources are, your friends and family. Some of you have raised money from friends and family, maybe some small amount of angel money. Government grants, and Neil talked about that. There's lots of support in Canada, so we're very lucky from that perspective. If you go down to the US, they're aghast at how much money our government gives our startups. So take advantage of that. And then you have, venture capital, the traditional VCs, and I'll talk a little bit about what that looks like. And some companies end up going to the public market. So they raise a little bit of angel money, maybe a couple of million, and then they do a reverse takeover or some sort to get onto the public market. In my mind, a young company going onto the public market is very dangerous. The first sign of a small misstep, your stock will tank, nobody will fund you anymore. So I know lots of companies that have had to go on the stock market because they couldn't raise money in other ways and have suffered as a result of it. So just be very, very careful if you think about the public market. Now, if you're a big and growing company like a Shopify and you've got revenues and so on and you're going public, that's a very different situation. But as a small company, I would not do it. So these are the general sort of categories of where you can get money from. In terms of, how do they fit into your stage of company? Of course, the angels, very, very early on is where you're getting angel and seed funding in that valley of death, I like to call it, because you're just developing a product. You have no customers. You don't have no idea whether this thing is going to succeed or not. It's the highest risk capital. Therefore, they want the highest return multiple, right? So they want your valuation to be very low when they invest because they're taking the highest risk. And then over time, you're going to get into this. Your product gets launched. You're going to figure out your product market fit. So then you might be raising your A round typically at that point. You might have a couple of customers, tiny bits of revenue. You're starting to de-risk, right? And then as your sales ramps up higher and higher, you get into your B rounds, right? Now you're talking about, I've kind of got my product market fit. I'm growing now. I'm figuring out how to scale this company. Those are all very different flavors of your company. From the initial angel, does the product work? Does the service work? To, oh, I got a couple of customers. Oh, and they like what I do. To, how do I make this really, really repeatable so that I can just pour more money on it and pour more gas on it? It just grows. Right? So that's your B round. B and C round is the gas. Don't take B and C money until you know you're going in the right direction. Otherwise, when you put on the gas, you run yourself into a wall and you die. Way too many companies do that. They take A rounds and they think, oh, I'm ready to scale. And they're not, right? And I see that all the time. They raise their A round and then they can't raise the next round. And they're not quite profitable yet. And they can't, the cost of sales is way higher than they thought, and they can't get it down to low enough. Like, there are all these questions about, is it time for scale? It's right around the A and B round is when you got to figure that out. But these are the general stages. Again, each stage has their own particularities. I'm not going to talk about it here, but if you have questions, I can talk to you more about it later. But again, here is just giving you a general overview. I talked about the VCs and the angels, and I think that's probably what's most relevant to you. What's driving the angels and what's driving the VCs and what do they look for, right? The angels are individuals. They're me. I'm an angel investor. I have a small angel fund called Panda Angel Partners. I do with a partner back there, Albert. So he's one of our partners there, and he has a big wallet with him tonight, so you can go and ask him for money. So angels have a very particular, they're invested in their own money. They don't have to answer to anyone else. So when I make a decision to invest in a company, it's because I like that company. Either I like the entrepreneur for some reason, or I like his technology, or I like the market they're going after. There's something about that project that really attracts me. And I don't have to answer to anyone else, and I'll just invest the money. VCs are investing other people's money. So when they do due diligence, they're going to be asking for all sorts of questions. And you're going to go like, why are they asking me this? This is risk capital. They should be willing to take risk. So yes, they are willing to take risks, but it's not their money. It's someone else's money. So they're much more careful, right? So very different profile when you go and talk to these people. Keep that in mind. Angels, you're selling the angel. You're selling the person. VC, you are, to a certain extent, selling the person as well. It's always about the person. But you have to package it much more so that they can then sell it to their investment committee. They can sell it to their partners. Their partners have to agree to the deal too, right? So again, very different. VCs typically need more proof. Angels, not so much. Angels invest, smaller checks, 25 to 100,000. They typically don't ask for board seats, but VCs almost always ask for board seats, right? The timing are typically, angels would like early exits as well, but a lot of them will hold on. They're quite happy to just sit there if the company's doing well. VCs, 4 to 7 years, they got to get their money out, and they will pressure you if they've been in your company for too long. Right? So very different kind of characters. So when you go out and raise money and you're going to run into this, you're like, I talked to 50 people, and how come nobody thinks my great idea is so great? It's not that they don't think your great idea is so great. It's that they have their own economics they need to work with, right? Like they see so many deals, VCs see so many deals, and they invest in so many deals, but I say it's 10 to 1, you might get 1 home run out of 10, but actually the percentage is smaller than that, right? It's smaller than that. So And I always tell the entrepreneur, it's not you, it's me. You know, I have a certain portfolio I need to build, right? I need a certain type of company to get me to that one home run. And there are some companies it's not that kind of company. It doesn't mean it's not a great company for you. And I'll talk a little bit about that. But you can see, you know, typically 50% either write-offs or just kind of get your money back. You have another, you know, 2 to 4 that, okay, I got like 2x, 4x, not too bad. And then you have 1 10x. You know, that's the typical return, right? And so it's a risk game, and they can't invest in all the deals that they like. It doesn't work that way, right? They have to invest in the deals that you often hear the VC use. It has to move the needle. It has to have the potential at least to go to a 10x. If it doesn't have the potential, the VCs won't invest. Now, you might think as an entrepreneur, I'm going to give you 5x return. That's wonderful. Like, I'm sure I can get to 5x. And they're going to look at that and go, that's not good enough for my portfolio, right? Because they're aiming for the 10 to 20 to 30x, or the potential for that. They need to see the potential for that, right? So if you understand that mindset, you understand why you're going to get a lot of no's from people, okay? And again, as I say, not every business is right for venture investing. You got to look at what kind of business you have. If you say, look, I'm gonna look in 4 years, I'm gonna be doing 10 million in revenues. That's great actually as a business. If you're profitable, you're doing 10 million in revenues in 4 to 5 years. That's pretty good. But the VCs will look at it and go, no, I want you to be doing 50 million, right? Because that's how they get their 10x. If you're not growing at that rate, the VCs can't exit at that kind of big valuation, because the valuation is all about your growth rate. How fast are you growing? The faster you grow, the bigger your valuation, right? So they're looking for that fast growth rate. And if you're not getting there, I see companies that come to me and they've been operating for 4 or 5 years. It's solid. They're doing 3 to 5, 3 to 5. Looks like they might go to 8 million in revenue next year. Solid business, right? Profitable. Anybody who's run a business knows that's a really good business. And a VC won't invest in that because you haven't shown that growth rate. Unless you come with a really great story why next year you're going to be tripling your revenues, and the year after you're going to be tripling your revenue because maybe the structure of your industry changed and now all of a sudden you can grow like this. But if you've been growing like this for like 4 years and you say, oh, I'm going to go like that in the next 2, I'm going to question that, right? So I'm looking for the growth rate. That's what VCs are looking for. If you think you can ramp up and you really have real opportunity to ramp up to $30 to $50 million in revenue in the 4 or 5 year range, then I think VCs will take a serious look, right? So know what kind of business you are, and then decide whether or not you want to raise VC money, because it takes a lot of effort to chase that cash. That's effort you can put into your own business and build a really solid business for yourself. Term sheet, oh, sorry, no. So what does VCs look for? I think you probably all know this, but it's so true. It's all about the founder and the management. Number one, that's what it is. It's the founder and management. And I'll tell you something else too. When the VCs or the angels, when the investors look for a deal, there's usually one thing they like about it. They have to like one thing. They can't say, I kind of like this, I kind of like this, I kind of like this, and then I'm going to do the deal. It doesn't happen that way. Usually there's one thing they really like. Like they love the technology for some reason, or they love the entrepreneur. And then what they do is they justify why they should make that investment in their minds. So it's a typical sales. It's sales 101, right? You get them emotionally hooked. The investor has to be emotionally hooked to you, into your business. And then what happens after they're emotionally hooked, then they're like, oh yeah, I can see how their market can be this big. Yeah, then this technology can be used. Oh yeah, this guy, he's young, but he can be trained. Like he's dynamic. Like they'll use reasons. I've seen investors do it all the time. They'll use their analytical brain to justify something they've already made a decision on, right? So when you're selling your company, your idea, you're selling. It's a sales. It's not, look at my numbers. There's got to be one hook that you got to know. This guy likes this particular hook. That's what I'm going to sell him on. And once he's hooked, he will find reasons in his own head to justify why he's making that investment. So it's funny because I know that because I've seen it enough, and I know I do it, and I still fall for it because that's human, right? So term sheets, as I said, I'm just going to skip all this because I think Mike's going to do it much better than me. There's a lot of terms you obviously should be considering in the term sheets, but we'll have some of that. I'll talk a little bit about valuation. This is, I think it's another topic that a lot of entrepreneurs get angst about. Is my valuation 1 million, 2 million? Should it be 5 million? I think this is the pie question that, the VCs will say, hey, don't you want a smaller slice of a bigger pie? That's how they sell you, right? And then I think Mike is going to say, no, it's good to have a big slice of a smaller pie. Anyway, so it depends on how you fund your company and what kind of business you have, right? But typically, you're looking at 3 to 5x revenues if you've got revenue. If you don't have revenues, at the end of the day, a lot of it is on the bottom there is intuition, negotiation, and what's happening in the market. So much of it is, what's the valuation going down in the Bay Area? What's the valuation up here? Investors see lots of deals, right? So if I see another angel deal doing it at a 3 million valuation, you're asking for 6. I'm like, no, that's not going to happen, right? And so a lot of it is what's happening in the market. And so when you go out and fundraise, the best thing you can do for yourself is go and find out what other people did their round at most recently in the last 6 months. Talk to your entrepreneurial friends. Talk to other people in these groups. Hey, what valuation? Once you kind of know that, that'll give you a sense of where you would be in valuation-wise, right? And a lot of it is hocus pocus. It's whatever you end up negotiating and whatever's happening at the time of that day, right? So no real rhyme or reason or metric or analytics. It's all just sort of like, what do I feel like today? And which way is the wind blowing, right? That's unfortunately, but that's the way we do valuation. This is my last slide, I think. So timing, that's the other thing that I have, you really have to give yourself lots of time. It's, I say 3 to 6 months to raise funds. Reality is more like 6 to 12, right? Especially up here in Vancouver. In the Bay Area, where there's lots of money chasing deals, 3 to 6 is probably reasonable. Vancouver, 6 to 12, right? Give yourself lots of time. So when you're planning your business, and you say, I need money, you got to think, okay, I'm going to get that money 12 months from now or 6 months from now at the fastest. So what do I need to do today? Who do I need to talk to today? And you need to start the discussion now so that in 6 months I can get the money, right? And so always think backwards when you're planning your fundraising is, I'm going to run out of money in May, so that means boom, 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 boom. I better start talking to investors in September, October. Because otherwise I won't be able to raise money. I'll be out of money in May, right? So give yourself that 6-month window at a minimum. And the reason is because VCs especially do a lot of due diligence. Angel investors will move faster. I have seen angels move very fast, especially angels, what Daryl was saying, we follow crowds. We're lemmings. Angel investors overall are lemmings, right? So, who's doing that? This person's doing it. Okay, and then I'm jumping in. And so your fundraising will move faster if you can get a lead. Find a lead investor. Find that one investor. They don't have to be putting in the most money, but they have to be your champions. They're the one that believe in you the most, right? So you might get a lead investor that's only putting in $50K. You might be raising $500,000. But if they're willing to champion you and talk about you and open up their network to their friends and so on, you'll get that round done much faster. Right? What I see a lot of companies get stuck in is they have, so-and-so said they're interested, and so-and-so they're interested, but nobody's moving. Nobody's sort of writing checks, right? It's because you don't have a lead. You find one lead, and you say, hey, so-and-so, he's leading. We're going to close the deal very soon. We've got money coming. Are you in? Right? Then all of a sudden, other people starts coming. So once you have a lead, it makes it much easier, right? But that's the general process from the VC anyway. There's lots of it's a slow process. They'll kick the tires for a long time. Even when they get to term sheet, it's not the end. The term sheet is not the end. The term sheet is, I've seen deals fall apart at term sheet. It's rare, but I have seen deals fall apart after the term sheet. Right? So there's been other VCs. I haven't seen it up here, but I know it happens in the Bay Area. There are VCs that will issue term sheet very fast to lock in the deal. And then they still do more due diligence. And there's actually a much higher likelihood that the deal will fail. Right? So there are VCs like that. By reputation, you can find out who they are. But in the Canadian market, it doesn't really happen that way. I haven't seen very many. Most of the Canadians won't issue a term sheet unless they're pretty comfortable with your deal already. Right? So the likelihood is high, but it still can fall apart. But again, 6 to 12 months is the timing you need to give yourself, right? So it's slow. So that's all I have actually prepared, and I think that's all the time I have anyway. But if you guys have questions, I don't know if you want to do.
Yep, we've got a few minutes for questions.
Yeah.
Okay, hold on one sec.
I'm just looking at the big block at the bottom of that basically, if I'm reading it right, says you have a 99.5% chance of not getting any funding from a VC.
Correct.
So, I mean, with everything that a startup is doing and how much of your time is consumed, when does this make any sense? I mean, honestly, if you're betting, are you kidding? Who's going to bet on a 0.5% shot?
Okay, so here's the question. As a startup, you need money. There's only two places you can get money. There's only two things you're selling. You're either selling your product, which means you're getting revenue to fund your company, or you're selling your equity. That's it. So if your product isn't selling yet, because you need more development dollars, you need whatever, you have no choice but to go and get other money. Otherwise, you can't build your business, right? There's only two places. And I would say if you can build if you don't have to go to VC or angels and you can build it because you're selling a good product, of course do that. Of course. Who doesn't want to do that? But sometimes if you're building a hard product, you can't, you need time. You need 6 months, 8 months, you need developers, right? You need angel money at least, right? And then when you want to scale, if you're building a SaaS business, right? You're only charging on a monthly basis. A SaaS business is notorious for receivables. I mean, you're always investing ahead of where the revenue is coming. That's where VC money comes in again, right? So sometimes you just have no choice. Yeah.
Hold on. Thanks.
Can we use VC money as kind of early exit? Or take the money, put it in
No, take the money and run. No, taking the money and run. They don't allow you to do that. In some cases, yes.
I mean, they make you to invest that money in the company. They don't let you to put it in your pocket.
No putting in your pocket. No. Okay, so there has been times when they have they buy out part of the founder's equity. So when that happens, so normally no. Typically for A round, very rare. Sometimes maybe for C rounds later. The companies are already quite big. And the reason why a VC might allow you to take some money out, or they buy your shares, basically the mechanism is they'll buy out your shares. They buy your founder shares. But the reason why they might want to do that is because they believe you can build $1 billion company, but you have opportunity to exit for $100 million. And when you exit for $100 million, it's good money for you, right? As a young entrepreneur, I'm going to keep $10 million. Oh, that's great, right? So you have incentive to actually sell. But the VCs don't want you to sell, right? They want you to keep building because they're like, oh my God, I've already put money in. You're going to be my 10x, right? They want you to keep going. So in that case, they may say, okay, you know what? I'll buy 3 million of your shares so that you have some money in your pockets. You feel okay, I can finally buy that house in Vancouver, although 3 million might only get you a shack. 5 million. 5 million. He's going to give you 5 million so you can buy a decent house in Vancouver. Now you don't feel like you have to sell the company. And you're willing to go for the $1 billion dream rather than the $100 million dream. In those instances, and there's companies like that in Vancouver that's happened, founders have sold their founder shares. And so VCs do a secondary and they buy part of the share. But it's rare. Your company really has to be on a rocket ship for them to do that. But A rounds, that never happens. No.
Any other? All right, one last question.
I'll tell you my case. I have an invention here that I started 20 years ago, and then I stopped it because I couldn't raise money. At that time, BCIT told me, if you put 20,000, we will put 10,000. Now, there's a new government law, the government guaranteed to the bank. He told me, I'll get $100,000 because he liked the project and everything, but I have to put myself 10,000. But I already spent 30,000. So from this money, Pioneer, he said, I don't have to put, I cannot receive even $1,000 salary. So it's okay, it doesn't matter. But it cost me $30,000 to make injection molding die and to proceed with the company. But who will give me $10,000? How to get it?
I don't know.
Why
Good
he don't-
question.
why-
Who's going to give him $10,000?
Why
Well,
don't he say, okay, you already spent $30,000, okay,
Yes.
no. So I'll give you 70,000, yeah. But that's what.
you know,
There's no money to start up. There
Yes.
is no money. You didn't say to any place where we can, anybody of us can go and ask to start up money. There's no money.
it's very difficult. That's why it's 5%.
I don't know, maybe
Oh, no,
venture,
0.5%.
maybe, yes.
I mean, I'm not disagreeing with you. It is a very difficult process and a very difficult, yes. Now, having said that, obviously there are startups here. There are startups that have raised money, right? So it's possible. It's difficult, but it's possible. Right? You have startups that are built, you have Build Direct, you have Hootsuite, you have companies that have built up to be pretty big. So nobody said doing startup is easy. Nobody said that. But it's worthwhile when it works.
All right, thank you very much. That was really,
Thanks.
really interesting. All right. And last but not least,
Oh, come on.
Mike Walkinshaw, CEO. It's Tamaya Capital, I believe,
Good.
right? I
Thank
watched
you.
the video.
Yeah, well, thank you.
you.
One sec.
Okay, so you have to unmute yourself.
I think I did. There.
Okay, you did. Okay, and it's just...
Can y'all hear me? Good.
Great, and then clicker if you need it. It's just side for going forward.
Okay. First of all, Angie, thank you for organizing all this. It's wonderful. You are a treasure in this startup community. Yeah. Get myself some applause. Oh, go on. Okay, my name's Mike Walkinshaw. I'm the CEO of a new finance vehicle in town called Tamaya Capital. We do revenue-based financing, and I'll talk a little bit more about that. Some of the earlier conversation, I think, resonated a bit with the problems that we saw in the financing ecosystem. And so we're out there trying to provide a product that I think answers some of those, at least some of the problems that you might see. Now, I've been a venture capitalist for 15 years, so don't throw tomatoes at me. I feel like I'm not a complete fan of the venture capital experience. I think both Jenny and I share some reservations about how the model works, and we're trying to give you a balanced view, I think, tonight of the pros and the cons of how the process works. And if you're going to pursue that pathway, then there are a number of things that you need to understand, and we're going to try and do our best to give you some vision on that. I am on the board of the Canadian Venture Capital Association, somewhat ironically, and will be so for a little while. Done many investments, and I've sat on a lot of board seats. So that's my background and experience in a nutshell. Now, as Jenny said, I am here to talk to you about pie. I love pie. Now, there's this cliche that I'm sure Jenny has used and that I have used many, many times, which is it's better to have a small piece of a very large pie than it is to have a large piece of a very small pie. And that is said many, many times by venture capitalists all over the world in 360 languages. That is what it is. But what needs to be considered is what happens if you have a medium-sized pie? Do you want the medium-sized pie or do you want the big pie? And what percentage of that pie am I going to end up with? Or what if your chances of getting to that large pie are 0.5 to 1%? Somebody needs to sit down and think about, what am I trying to achieve here? And what's really important is you're trying to maximize the sheer square footage of pie that you get. That's what's really important. So whether that comes in the form of a small piece of a gigantic pie or whether that's a very large piece of a very small pie, it's up to you to figure out what's your best pathway forwards. So when it comes to financing, there's a number of different options to pursue for your financing pathway. But before I go there, I'm going to talk a little bit about something I think Jenny also talked about, which is how does the venture capital model work? And it's really important to understand this before you approach that sector. So if you have a fund, a venture capital fund that's $100 million, you take $15 million of that and you throw it off the top for fees and other expenses through a 10-year period. That leaves you with $85 million of investment capital, which you're going to put in probably 12 investments. Now, I have clearly a higher return expectation than Jenny does, because I said 3 out of 12, but it could be 2 out of 12. It could, in fact, be 1 out of 12. But the idea is that you need to take that $85 million and you need to turn that into something north of $300 million over, some say 5 years, some say 7 years, but definitely by the end of your 10-year fund life. And that $300 million comes on the back of 1, 2, or 3 investments. So that means, and also on top of that, you're only going to own something like 10, 15, or 17% of that investment when you actually get to selling that investment. So if I'm going to return $300 million through 3 investments, it's $100 million per investment. And oh, by the way, I'm only going to own 15% of it. That means I need to see every single investment in my portfolio. I need to have a pathway to believe that when you sell that company, that's an $800 million company or a $1 billion company or a $2 billion company. So if you're going to go seek venture capital, you need to fundamentally build a credible story that says over 5 to 7 years, I'm going to create a $1 billion company. Now, it's happened. It doesn't happen a lot, but it has happened, and it is possible. So don't walk through the door and say, I'm really hoping to build a company for $50 or $75 million in 5 or 7 years, because VCs are not capable of having that conversation. So there was some data that came out today that I thought I would just throw in here because it's kind of interesting, I think, for the conversation. So top VC sectors, Q1 of 2016 in Canada. Okay, this is CVCA data. So 86 deals. So these are numbers of deals. These are numbers of deals on the left side there. So 86 deals that were done in the quarter were ICT. 17 life science, 10 clean tech, 4 agribusiness, 1 other. So that gives you a sense of the total number of VC deals that were done across Canada in Q1. Something in the low 100, 110, 115 range. And 86 of them were in ICT. Life sciences a little bit, clean tech a fairly small number, agribusiness even a smaller number. And the reason that so many ICT deals get done is because the capital profile of that sector fits well with the VC model. Relatively low capital in, quick acceleration into the global marketplace, lots of money back if you hit it right. These other sectors are really suffering over the last 10 or 15 years because there's heavy capital requirements, long time frames to acceleration. So you're starting to see, especially in Canada, if you had looked at this data maybe 5 or 7 years ago, what you would have seen was a lot more clean tech deals were getting done, but they're not getting done right now. And there were time periods where life science deals, there was a lot more life sciences deals getting done. Those are not getting done in Canada right now. Sure, question.
Oh, hold on.
So if you're looking at that from a government perspective,
yeah,
then you're going the opposite way. You're going to stay away from ICT because the private sector is killing that, and you're going to fund life sciences, clean tech, agribusiness, and bring up the rear, so to speak, to almost balance it out. Otherwise, I mean, you look at that and you're like, okay, I got a 0.5% chance of getting some VC. From that 0.5, if I'm not ICT, forget it, right? I mean, so I'm going to just forget that whole concept. I'm going to go to the public sector. I'm going to go to the government. I'm going to try and get my capital from there because they know the same thing I know. Yeah. Would that be a credible strategy as a startup in life sciences?
So it is. And certainly with carbon funding on the clean tech side, there definitely is a lot more money coming through the government in the next 4 or 5 years. Yeah. The problem is you need to find a matching, generally speaking, depending on which program you're in, the SDTC, for example. Right. You need to find 65% of the funding and they'll match the 35%. So it is a huge issue that the government wants to fund clean tech, but there's no 65% matching funding for clean tech from the private sector. I don't have an answer for that problem. Maybe that changes or turns around in the next few years, but that is the major issue. But I agree with you. This data is very well understood by the government, the Ontario government, the Quebec government, and the BC government. So most active VC firms. Here's something else I'll point. So there's 10 VC firms. Those are the total number of deals they did in a quarter and the dollar value. Of note, the very last one is the only one that's based here in Vancouver. And there's an axiom that says that venture capital doesn't travel very well. Why? Because you need personal relationships. You need to believe in people. You need to be able to go to board meetings relatively easily. You need to be able to pick up the phone and call people. You need to be able to help solve problems. So there's only one VC in Vancouver right now that made that list, and that's Yaletown. That's private. There's one in Alberta, which is Avrio, and then every one of these is mostly in Ontario and one in Quebec. So as a BC startup community, we have an issue, and the BC government is trying to do something about this under this BC tech strategy you may or may not have heard something about. They're trying to address this problem, but it's going to take a lot of work to get this sorted out. This didn't used to be like this. I started in VC in 2002. British Columbia was definitely second place in the nation in terms of the amount of VC dollars that were available for startups. That is no longer the case by a long shot. So that's a trend that's going on. I hope we can reverse that trend, but it makes starting a company very difficult in this particular location. So I won't belabor this. I think Jenny talked about all this, but clearly there are multiple financing options, and it really depends on the capital needs of your business. If you can get away without going to the VC community, if you can get away with customer financing, or you can get away with friends and family and angel financing, then by all means do so. But what it also means is that every dollar that goes into your business is really, really precious, because it's really hard to get more and more dollars. And you can assume that as you move from low complexity to high complexity, that it also means that it gets more expensive. So the point was made earlier, the VC dollars. Very few people do the calculation as to what the IRR on VC dollars is, the interest rate on VC. It is at least 50%. It could be 100, it could be 200. It really depends on the exit that you achieve at the end of the day. It's got a 0% interest rate if you completely fail. But if you achieve some measure of success, they're going to take their pound of flesh. So let's step in and go a little deeper into the equity investing. And let's talk about some of the terms that I think really this group should focus on when you go into this. And these terms could be applicable for angel financing. They are applicable for VC financing. But really what it is it's a negotiation, and it's a partnership that you're creating with another player who is trying to get as much money as they possibly can. So go in with your eyes wide open, understanding the relationship. This is a financially based relationship. Understand the game before you get into it, or if you don't, find people who do, who can help you. And there are those people. So it all really boils down to a shareholders agreement, which is the understanding of the business and the relationship between the parties that are investing in that business. How are we going to play this investment game together as a group when we all invest in your company? So there's some gives and some gets in this. What does the entrepreneur want? Well, of course, they want the capital, they want the value-added skill sets, they want customer introductions to customers and strategic partners around the globe, and they expect an absence of value destruction. They do not want you to hurt their company. They expect you to be a good investor who's going to create value for the company. Now, the investor, on the other hand, what they want is they want a big return on their money, certainly greater than 10x. They expect consistent progress updates, especially your angel investors who don't get that very often. Give them consistent, routine updates on how you're doing. They want an opportunity to help improve the outcome of your company as much as they possibly can. They don't want to be unduly crammed down in the future when you hit a road bump, a bump on the road. And the latest investors, generally speaking, want some sort of seniority in the cap table. They want to be more senior than the other investors, but that's sort of a flexible thing over time. So there's a number of key terms in here, and I've just I think we can share this presentation. So this is all in here. I won't go through every one of those. But these are really the core basic rights and provisions that are in a shareholder agreement. The top three are underlined. And those are the ones I'll talk about in the next two slides. So what kind of shares are you issuing? Are you issuing common shares or preferred shares? Preferred shares lay over top common shares. They're senior. So if you liquidate the company, the preferred guys get their money first, then the common guys get their money. And that's just like an extra security provision for your investor. It gets really complicated when you have preferred share Series A, then B, then C, and there's some sort of really complicated waterfall that goes through that. The second key term you will hear is something called a liquidation preference, which means that if you sell the company, I get 1x my money back, I get 2x my money back, I get even 3x my money back. So you might hear the term a 2x liquidation preference. That means if the company gets sold and I've given you $5 million, right off the top I get $10 million back. That's my baseline. And then you start to see a dollar. So that's like a guaranteed return over time. If there's money available at the sale of the company, you get that money back. So understand liquidation preference has a big impact, and I'll give you an example in a minute. The third term is participating. So it's often used in conjunction. You will hear 2x liquidating preference with a participation, or participating 2x liquidation preference. So what that means is not only do you get your liquidation preference, you get your 2x on your 5 million, you get 10 million back. On top of that, you then get to participate with the common shareholders after on a pro rata basis on whatever proceeds are left. So you would, in your preferred investment, you would in fact get even more than the 10 million back. So these are the three core terms that I think drive a lot of the economics of how these deals pay out to the underlying investors. And there's a whole bunch of other ones that are about control provisions, they're about information rights, they're about future investment rounds. But the ones that really drive the economics are those three terms up top. So let's talk about quickly who wants what in this matrix. You've got your entrepreneurs, you've got your angel investors, and you've got your venture capital investors. And again, just focusing on the top three, what's best for an entrepreneur is common shares, totally flat. Everybody's on the same page. Angels, they're usually on the same page, but sometimes they want a little bit of preference. It might be called a seed preferred share, which sits on top of the common shares. And then your venture capital guys walk through the door and ask for preferred every single time. So that's immediately right off the bat a bit of a break in the chain from your entrepreneur to your angel to your VC. You have to figure out how to deal with that. Your liquidation preference. For the entrepreneurs, it's considered to destroy value. It makes life really complicated when it comes to selling the company. And I'll give you that example in a second. For angels, some of them ask for it. And VC guys, they always want that liquidation preference. They want a 1x, they want a 2x, or even a 3x. So be very careful around that one. And then finally, participation. Again, same thing. Really destroys the value of the company, misaligns the economics. The VC guys always want it. Now let me get to this example that I think probably clears up some of the understanding of this. So this is a very common problem that I've seen many times, and I'm sure Jenny has seen. So Acme Co. has a common and a preferred share structure. And let's say the preferreds have terms that say participating with a 2x liquidation value. So $20 million gets invested in Acme Co. That's $5 million of common and ultimately $15 million of preferred. Now, Acme Co. didn't work out very well. The product wasn't that great. Competitors came into the marketplace, and eventually what happened was somebody came along and made a $40 million offer to sell the company. Now, at this point, given the positioning of this product, given where this company's at, given the likely need for more capital in the future, the obvious best decision is to just sell it for the $40 million and get the hell out and go start something new. But here's what happens. Take your $40 million. The VC goes, well, that's great. I'll take 37.5 of that 40. because I got my 2x liquidation preference, so my 15 turns into 30. Oh, and I'm participating, so I've got 3/4 of the share capital of the company, which means of the remaining 10, I get 7.5. So I got $37.5 million. And by the way, you, the common shareholders and management, you get the remaining 2.5, and you guys can all split it up. Well, guess what happens? Management says, I'm not doing that. Forget it. There's no way. I'm not going to sell the business. Why would I sell the business for that number? And I've never seen a business get sold if management wasn't actually trying to help sell it. So the economics of that lead to chaos. So what happens is then you have a renegotiation, and in this very delicate time when you're trying to sell the business, you have management saying, I want to renegotiate the deal. You have the common shareholders talking to the preferred shareholders trying to exert rights. It gets very complicated. There are ways to solve these problems, but it is not the best time to be having these arguments when you're trying to just get out of this deal. And ultimately, a negotiation ensues, and lawyers make a lot of money. So the point is that you have to keep your cap table as flat as you possibly can in these situations. Keep the liquidation preference as low as you possibly can. Keep the participation out if possible, but if not, understand what it means at all times. And certainly explore all opportunities, all variant opportunities for financing. Now, one of those variant opportunities for financing is something that I've decided to pursue because I've seen these problems for years and years and years. And what I've seen is a company that's going to sell for $75 million, as Jenny said, is a great company. You know, it's a $25 million SaaS company. It's got a 3x multiple. It's worth $75 million. If the entrepreneur owns 55% of that company, that's a great exit. That's a big check for that entrepreneur. That company will never get a VC financing. So why is it that we can't finance those companies? We're in Canada. The Royal Bank's not going to finance that company. So the Silicon Valley Bank might, Comerica Bank might. There's a few players that might, but there isn't a lot of money for those kinds of companies. So why don't we create a financing vehicle that will finance those companies, that will finance the really good companies, the companies that are going to grow and be valuable. They just aren't going to hit that billion-dollar number. So the basics of what we do is we find a company that's got a good growth, 20% a year, 30% a year, 40% a year, 50% a year. And we give them money, and they pay us money back. And they pay us that money back as a percentage of their sales, a royalty on their sales. We don't take any equity in the company. We don't dilute ownership. We don't take board seats. We don't have participation. We don't have liquidation preferences. We don't have any of it. We simply have a royalty payment that you owe me until I get paid back a specific amount. So if I give you $1 million, I'm expecting you to pay me back $2 million. It's a 2x amount. And you pay it as a monthly payment, a percentage of your revenue until you've reached that 2x cap. And that is typically 5 or 6 or 7 years. Now, people say, oh, I don't like royalties on my sales. It kind of sucks cash out of the business. That is, of course, the quid pro quo. However, in the case of a SaaS company, the company's value for every dollar of revenue is going up by $3. So you're going to pay me 5 cents for every dollar you add to the business in revenue, but you're going to get $3 of value. So that's a good deal. That is something that grows with entrepreneurs. Goes well. So that's our product. So we're providing this product into the marketplace now. We've been doing it since last summer. It has no dilution. Your payments flex with the revenue growth. If your revenue goes down, so does your payment to us. If your revenue goes up, so does payment to us. We make a great return, and Sam, the entrepreneur, gets to grow the company her way. So that's the product that we're offering. Now, we're not the only players offering that, and this isn't a promo for me. I guess it is a little bit, but there are other players that do that. There's Grenville in Toronto. There's Lighter Capital in Seattle. There are Van Cities offering some very, very interesting debt products to local tech companies. The BDC has a full suite of products that they can offer, some of which are equity and a lot of which are debt. There are multiple different players out there in the marketplace that can offer debt or debt-like products that can get you to where you need to be. The only problem with us and many of those other players is that we can't give you financing until you've got some revenue. Because how can you start paying me back if your revenue is zero? That's the downside with us. And the other downside is we're taking cash out of your business every month. The upside is you keep all the business. So those are some of your financing options that you can see on that front. Now,
One question.
yeah, well, just let me summarize here. This is the last slide. So to get the most pie, keep your cap table as flat as you possibly can for as long as you possibly can. Understand your total capital requirements to get to $10 million in revenue. And if that's a small number, maybe friends and family, angels, and some of these other debt-based solutions are the answer. If it's a big number to get to $10 million in revenue, then you're going to have to go the VC route, and you're going to have to get comfortable with that. And finally, if you do choose to pursue venture capital, or if you need to, really understand the rules of the game and get people behind you who know how that game works, who can advise you along the way. Okay, thanks. Question.
How many years are you looking back before you consider that consistent revenue model?
So we're focused, us particularly, we're focused on SaaS revenue, software revenue companies. So we're looking back 12 months to 18 months. And because they're recurring revenue contracts, it's pretty consistent. Yeah.
What's the normal range of deals that you guys have for the SaaS model?
So we'll invest as little as $300,000. We'll do as much as $2 million. We'll typically do it in tranches. So if you're small, we'll start with a small number, and then as your revenue grows, we'll invest more to fill in the gap. The other debt players around will do, like the BDC will do as small as $75,000. Van City will do $75,000 to $100,000 and go upwards. So there's different players there.
Okay.
Are the companies using this when they work with you to actually sort of build more credibility to their business because it's steady as she goes, rather than we just got more investment in us. So
yeah,
are they kind of turning it around and using that to our advantage? Like I was on your website and I saw that you've released like all your your press releases, but are they doing that as well to their credit? Because I could see a benefit there.
So some are and some aren't, I guess is the answer. So we see a couple different use cases, and this would be no different than any other debt provider who's out there. They'll see a couple different use cases. One is an entrepreneur who, through friends and family money and customer financing, has gotten the business to $3 million in revenue, $1 million, $2 million in revenue, whatever. And they go to talk to a VC, and it's the first conversation they've had with a VC, and they think their $2 million revenue business is worth like $14 million because they just spent the last 4 years of their life and all of their relatives' money getting to here. The VC goes, well, you're doing $2 million, that's sort of 4, maybe 5, give you maybe 6 at the max. And there's a huge valuation gap there. And so they're like, forget it. I'm not dealing with you. You're trying to steal my business. And that's the end of the conversation with the VC community. That's A. That person doesn't typically come and press release that they got money from us or that they're making a big deal about it. The second use case we see are angel-backed companies that maybe are good companies. They've gotten to that $3-4 million revenue plateau, but they took like $10 million of capital to get there. So it's, the angels are tired. They want out. Too many rounds of financing. They're maybe a little bit more keen on press releasing some of this stuff. Go ahead.
So if the company has revenue, can they issue corporate bonds instead of going to that deal?
I don't think that size they can. Yeah, I don't. You could do if you get a bunch of angels to do a convertible debenture or a debenture, there's no reason you couldn't do that. Depends on the angel group.
One last question.
Hello, my name is Akmal. I just want to ask, was there any case when the entrepreneurs are doing business and VCs are coming to them and saying, we want to invest to your company?
Say that again. Was there a case when what?
When the company has a good product, doing good business, and everybody likes their product, and VCs coming and saying that we want to invest to your company to scale it, because we see the potential of your company?
No, it happens, absolutely. So one of the things we haven't said here is there's a couple of, if you do want to go the VC route, it's really important to understand that one of the things a lot of VCs do is they don't just sit back and wait for you to come to them. What they do is they say, I want to do virtual reality. Okay, I think virtual reality is a great theme. I'm going to invest like crazy in virtual reality. So then they go and they sit down and they've got 4 analysts, in computers, and they scan the globe for the best VR companies. And then they make a huge report. They figure out that there's really 5 leaders in the VR space. 3 here in North America, 1 in Asia, 1 in Europe. So then they go and they approach those 5 VR companies and they try and figure out if they can get an investment in those companies. That's a thematic investing is a big part of it. And often entrepreneurs will approach that investor and they'll be like, hey, I got a great company that's doing something that, completely different. It'll seem like the investor's not interested. And it's not because you don't have a great deal. It's just because they're focused on VR right now and that's all they want to do. So you can get approached and it can happen globally. It's pretty rare, but it does happen for sure.
All right, I'm pretty impressed. 4 speakers. We had perfect time tonight. So thank you again, Mike. All right, so Jenny, Mike, I think Daryl, are you still here? He was here. Maybe he left. But Jenny and Mike can probably stick around for a few minutes if you have more questions. Otherwise, thanks again. Next week, we'll see you back here, same place, same time on pricing. Otherwise, good night. Thanks again.